नरघट तक है तेरी कहानी पग पग प्यारे दंगल 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 सूरज तेरा चढ़ता ढलता गर्दिश में करते हैं तारे दंगल 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 दंगल
Lecture 4. दोस्तों, friends, we are going to start with lecture number 4 and the topic is leverages. Very beautiful small topic. We will be going to complete within 2 or 3 lectures again. It means this reading will be completed within 6 or 7 lectures max. If I see capital budgeting, I have covered, I think I have delivered 13 to 14 lectures. In case of cost of capital, 18 lectures. But this is a very smaller reading and very beautiful concepts are framed in this reading. CFA level 1, we are preparing for June, December. So today's lecture will be lecture number 4. I will be delivering 4th lecture in leverages and I will be concluding in 5 to 6 lectures. Today, we will be covering with learning outcome number C, which is the most important learning outcome, which is generally being testable in your examination. Even if you see practice test papers from your site, or if you see other series, mock test series, this ROE concept, the concept which I am going to start today, is the most important concept, which is general leverage. How an entity having financial leverage can also affect ROE. It means disproportionate change. It means disproportionate change in financial leverage. There will be a disproportionate change in ROE. Along with that, the rate will also be, there will be a disproportionate change. I know that you are not getting the point, but before we start with the main concept, please take out your registers and please start writing down the things. Please take out your registers. Lecture number 4. Lecture number 4. Great morning. Reading 37. Learning outcome C, and I have written a quotation for you. Today's quotation is push yourself because no one else is going to do it for you. You have to push yourself for June and December because no one in this earth will do it for you. You have to do for yourself. So in case you want to clear your examination, you have to do hard work. You have to push yourself because time will never come. Time will not wait for anything, So let's start. Now, before I start with, this is learning outcome C, effect of financial leverage on net income and return on equity. Now, when I say net income, it means profit after tax. It means EAT. It means PAT. It means it has different synonyms: net income, profit after tax, earning after tax, net, and anything. It means the profits which are available to shareholders after paying tax. That profit, that net income is named as net income. And how to calculate return on equity, because we have to see the relationship of financial leverage and return on equity. In the last 2-3 lectures, we have seen that how there is a change in sales can affect EBIT, and how there is a change in EBIT can affect EBT, and how there is a change in EBT can affect EPS. Now we are moving towards return on equity, that how ROE can be changed with the change in that profits. Because if there is an incidence of financial leverage, then there will be a disproportionate change in ROE also. Even the rate at which ROE will increase or decrease, that will also change. So please write on first point, what is the meaning of ROE? When I say ROE, I mean return on equity. It is ROE, small name. It means how much is the return. Return on equity, as the name indicates, return means profits for equity. It means how much profits are there for equity, how much profit an entity is able to generate for equity shareholders. So there are 2 sources, there are 3 sources of funds. One is debt, second is preferred stock, third is equity. I am talking of equity. When I say return, I mean the profit which you are earning for shareholders, for equity shareholders. And the formula is earning after tax upon equity into 100. This is the formula which we use, earning after tax upon equity into 100. Now, because I want to tell you the impact of financial leverage, how financial leverage can impact ROE. So for that, I have to use some numbers. So I'm taking the example of a case study, help of a case study. In this case study, you have to divide your page into two parts. Firstly, see the data, the numbers which I have given to you. I have taken the example of two organizations, organization A and organization B. Both the organizations are brother and sister. They have same sales. They have same variable cost. They have same operating fixed cost. They have same EBIT. But one organization A has gone for 100% equity and organization B has a debt equity mix of 80% and 20%. It means 80% is debt and 20% is equity. Rest all the things are same. Now we will see that how with a change in the capital structure there will be a change in ROE. How ROE can be changed or the rate at which it can be changed. So let me move further. Please divide your page into two parts. Please see in the left hand side I have written organization A, in the right hand side I have written organization B. Firstly don't write this increase in 20% or increase in 20% column. Just leave the space. Just leave the space. Organization A. Organization A. There is one basic example that sales is 2000, which I have just told you. In organization A also sales is 2000. In organization B also sales is 2000. In organization A, variable cost is 500. In organization B, variable cost is 500. Contribution is 1500. Contribution is 1500. Operating fixed cost is 750. Operating fixed cost is 750. EBIT is 750. EBIT is 750. It means up to EBIT, up to school level, both are same. The treatment is given same to these twins. But after that they have different colleges. One is in the boys college separate, or and second is in the co-ed college. Now we will see the difference in the treatment, in their behavior. EBIT is same, that is 750 and 750, because organization A has not employed debt, so there is no liability of paying interest. So interest in organization A is 0. So it means EBT is 750. When I say EBT is 750, I can calculate degree of financial leverage. That is EBIT upon EBT, and that is 750 upon 750. That is 1. I have calculated 1 for you, degree of financial leverage. You're writing now? Please write down, my dear friends. This case study will help you in telling me the how financial leverage can magnify the ROE effect. How financial leverage can magnify the effect of return on equity. Tax 20%, EAT is 600. Now EAT, earning after tax, is 600. So this is organization A. I'm not talking firstly of this column, this increased column. Please don't prepare, just leave the space, don't prepare it. And for organization B, again I am starting with EBIT. Now because they have employed debt, so I am assuming let the interest be 250. I am just for calculation's sake I have just assumed a number. 750 minus 250 is equal to EBT is equal to 500, and less tax. Tax is 20%, so 500 of 20%, 100. EAT is 400. Don't write that increase column now. Just listen to me. I have given you two income statements in my case study. One is organization A and second is organization B. In organization A, I have given you sales, variable cost, contribution, operating fixed cost, EBIT, interest, EBT, tax, EAT. Now EAT in organization A is $600 million and EAT in organization B is $400 million. So you must be wondering that in organization B, EAT is less. Okay, no problem. But I want to calculate how much is ROE in organization A and how much is ROE in organization B. Now for ROE, we know the formula. EAT upon equity into 100. So in case of organization A, if I want to calculate ROE, that will be 60%. But in case of organization B, EAT is 400, but we have employed equity as 200. So that is 200%. It means on every rupee, on every 100 rupee or $100 of equity, organization A is giving the return of $60. And in case of Organization B, on every $100 of investment by equity, organization is giving a return of $200. So there is a difference, $100, $200, and in first case there is a return of 60%. But natural, as an equity shareholder, you will go to organization B because organization B has a higher level of ROE. So up to this case study, up to this part, we have seen that in case there is a debt equity mix, there will be a change in ROE. For example, in this I have seen DFL, degree of financial leverage, as 1.5. Please see to it. EBIT 750 upon EBT 500, 750 upon 500, that comes to 1.5. My dear friends, today's lecture is on how financial leverage can magnify the effect of return on equity. Organization A and organization B. In organization A, degree of financial leverage is 1, and in organization B, degree of financial leverage is 1.5. In organization A, interest is missing because 100% equity. In organization B, interest I have assumed because $800 million is the debt, so let the amount be 250. So 750 minus 250, EBT is 500, tax is 100, and EAT is 400. So like this, I have told you that in case there is a financial leverage, ROE will be changed from 60% to 200%. Now, but natural that shareholders will go for organization B. Now again, I want to show you some more implications. So I think you must have left the space for that 20% increase. Now I am coming to this 20% increase. Supposingly there is an increase of EBIT by 20%. Then we want to see that by how much ROE will increase in organization A and again in organization B. Now EBIT is 750. If I increase it by 20%, that comes to 900. That comes to 900. Interest is 0. EBT is 900, tax is 180, EAT is 720. So from 600 it has increased to 720. So it means how much is the increase? 720 minus 600 upon 600, it comes to 20%. So in organization A, where interest is missing, that is 100% equity firm, if EBIT increases by 20%, then EAT will also increase by 20%. I have just shown you. Then EAT will also increase by 20%. Now we will see that whether ROE also increases by 20%. That is 720 upon 1000. Just see to it, 720 upon 1000 into 100, that comes to 72%. It means from 60% to 72%, the difference is 12. 72 minus 60 upon 60, 12 upon 60, again that is coming as 12 upon 60. 12 upon 60 is equal to 20%. It means what I have concluded, that if interest is not there, if the firm is 100% equity, if there is an organization A case, if financial leverage is 1, it means there is no magnifying effect of financial leverage, then the percentage change in EBIT will be equal to percentage change in ROE. But if there is an incidence of interest, if you have to take fixed amount of interest, we will see how there is a magnifying effect in ROE. Because in organization B, we have taken financial leverage as 1.5. How 1.5? EBIT upon EBT, 750 upon 500, that comes to 1.5. So please write down this column now. Please write down this column. Please write down this column in that income statement. If we increase EBIT by 20%, then from 750 to 900, then less interest 250, then the balancing figure is 650, tax is 130, EAT is 520. Now the point is, from 400 to 520 we have increased. Earning after tax has been increased by 30%. That is okay. Because 20% into 1.5, that comes to 30%, but we want to calculate by how much percentage ROE has been increased. So 520, if I do 520 upon 200 in 200, that comes to 260%. My ROE has increased from 200% to 260%. That is, from 200 to 260 means by 30%. So now see these figures. Now I have given you the example. Now please write out ROE in case there is an increase in EBIT by 20%. ROE in case there is an increase in EBIT by 20%. In case there is an increase in EBIT by 20%, organization A, 720 upon 1000 into 100, that comes to 72%. It means from 60 to 72 there is an increase by 20%. In organization B, 520 upon 200 into 100, that comes to 260%. It means from 200% to 260%, there is an increase by 30%. So there are two implications in this. ROE, I am telling you the effect of financial leverage on ROE. Learning outcome C. Now there are two implications, two interpretations. These interpretations are very important. Please write down, my dear friend. Please sit straight. Practice makes the man perfect. Please write down interpretation 1. Financial leverage will help in. It means there are two implications. First is it will help in magnifying the impact on ROE. Because we have seen in organization A, there is no impact in magnifying in ROE because there is no interest, no debt. But in organization B, it has impact by 30% because financial leverage is 1.5%. If I increase EBIT by 20%, my ROE will increase by more than that, by 30%. So please write down. Financial leverage will help in magnifying the effect on ROE, as with only 20% increase or decrease in EBIT, there is 60% increase or decrease in So interpretation 2, even the rate at which that ROE increases will also increase, because in organization A the rate at which ROE increases is 20%, but in organization B the rate at which ROE increases is 30%. So please write down these things, 2 points. Financial leverage has the impact on ROE, and financial leverage also has the impact on the rate at which ROE is increasing. There is a difference between interpretation 1 and interpretation 2. The rate at which ROE changes will also get magnified, because in case there is a change in ROE by 20%, that is from this to this. But in organization B, the rate at which ROE increases is 30%. If we increase 20% by EBIT, there will be a change in ROE by 30%. But in organization A, there will be a change by 20%. It means even the rate at which ROE is increasing or decreasing, that is also magnified with the help of financial leverage. So I can say there is a direct impact of financial leverage. There is a direct impact of financial leverage on ROE. There is a direct impact of financial leverage on ROE. It means if financial leverage increases, there is a disproportionate change in financial leverage. ROE also, there will be disproportionate change. Hope you have written that. Please write down important note, last slide of lecture number 4. If EBIT increases or decreases disproportionately, because with the help of sales, if or contribution, EBIT will also increase disproportionately because there is an incidence of operating fixed cost. So if there is an increase or decrease disproportionately in EBIT, then ROE will also increase or decrease disproportionately. Then ROE will also increase or decrease disproportionately. So my dear friend, I have just told you how there is a relationship of financial leverage with ROE. How financial leverage has an impact on ROE. So hope you have enjoyed this lecture. Hope you have written the case study. Hope you have understood the concepts. Shabak hai. Dua salam. Be happy. Be jolly. Be cheerful. Be happy. Be jolly.